So we're 1 hour from the open in the US. It'd be interesting to see what happens with Facebook. We were down almost 10% in 2 days in Facebook shares, and it's looking like another pretty soft open. So we're looking like we're going to be down over 10% in Facebook shares in 3 days, which is quite mad, quite potentially interesting. I think once Zuckerberg actually steps up and said something, I think that in itself will probably allay some of the concerns, even if he doesn't say anything particularly useful. But let's see. Anyway, obviously that's Facebook's the big market topic at the moment. But for today, we are not specifically talking about Facebook. We are talking about the ABC trading pattern. Now, it's actually such a simple pattern that I'm hoping this webinar doesn't have to drag on too long without you guys pretty much getting a pretty decent understanding of what it is and how it can potentially be used. I'm assuming you've all read the risk warning at this stage, so let's jump through to the beginning slide here. So this is what I wrote in the description for the webinar that you probably have all read, but the ABC, or sometimes called the 1, 2, 3 trading pattern, is one of the simplest yet most effective entries for trade triggers available. It can be spotted in any time frame and in any market, so that's key obviously, because you can be a day trader, a scalper, a long-term position trader, and this pattern still has some validity. So how do you define the ABC pattern will be the first element to the conversation. What is the pattern for? So you would think that's a fairly straightforward answer, but it's sort of not, because in a way, anyway, I'll get into that in a minute, but you saying the word trading strategy is almost a little bit incorrect, I suppose. How do you apply it? And then we'll go into some live examples from the trading platform. Now, I should say I don't have anything specifically set up in the trading platform. So if there was any particular market you wanted me to look into and try and find some examples of the pattern working, and of course it does fail as well, looking out for both examples of those, that would make life easier. I'll look into the markets you're interested in. If not, obviously we'll cover some of the kind of classic popular markets. So how do you define the ABC pattern? It's very simple. So it involves 3 swings, which are obviously labeled A, B, and C. So the key here is that it's a very simple pattern. You're looking for these movements in the market, and that your entry into the market can either be a buy or a sell. So there's a bullish version and a bearish version. So you can see 2 of them in front of you. So I think you should be able to see my mouse on the screen. So literally this is the situation. So something down here, there's some kind of support, or we're in a generally good environment for buying, and the market's pushed up. It pulls back. Now it can be whatever distance. Obviously the deeper it pulls back, the softer the market. The shallower it pulls back, you can't so easily define it as a pullback, but something in the region of about 50%. It pulls back. So A was the first line, B was the second line, and then C is the really interesting one. C is where you get the confirmation. You get the break of the high from A is your signal to go long with hoping for the extension of C. And if you're looking for a bearish example, you've got the A, you've got the B, and then you've got C here. And again, you've had that push lower, you've had a retracement, and then it's when you're taking out the low from A, that or the beginning of B is where you get your sell signal. Now there are some people who try and kind of jiggle this idea around a little bit and say, well, wait for some small confirmation at the end of C and buy down there, at the start of C, rather than waiting for a break of B. No, that's completely defeating the object. The idea is that this break of the end of A up here, obviously, or here in this case on the sell signal, That is the confirmation that you're looking for. That is that is momentum for the sellers in this case, and the buyers officially taking over. So the idea here is that you're not trying to get in at the very low of the market. You're waiting for this little pattern to set up for when the momentum is right in your favor. I'm going to talk about that a little bit here. So what was I jabbering on about at the start, that it's not entirely a trading strategy? It's not a trading strategy by itself. Trading strategy involves a lot of different elements, you know, in terms of risk management and, you know, how you identify the trend, etc., etc. This is simply the entry trigger for how you get into the market once you've done that other analysis. So it's not an entire trading system by itself. The idea is that you've already decided you want to get long or short, and that you need a trigger just to get in there and place the trade, ideally when the momentum is just turning in your favor. So I don't know about you, and this all comes down to different people's psychology. I don't like buying on just the kind of raw dip, just because obviously you don't know if you're right each time, but you have to sit around and wait. Oftentimes when you're buying purely on the price retracement by itself without any confirmation, the price inevitably heads a bit lower. You can never quite find the bottom when you're buying. You can never quite pick the top when you're selling. So you have to wait for the price to keep moving past you. And you oftentimes have to sit in a loss for a while. And it just requires a lot of patience to sit through that. The idea of this pattern is that you push through, take out that short-term high in the case of a bullish breakout, or take out that short-term low in a bearish breakout, and the momentum's in your favor. So as I sort of alluded to, it's sort of like you've got to have already decided you wanted to buy around a certain price point, and then you're just looking for this pattern to occur to confirm to you that that price point is right. So there will be ABC signals in the market all the time. They're not necessarily valid signals if they're not at a price point you're looking for. So it's not effective to take every single signal. And this is obviously not going to be news to most of you. It's like any technical indicator. You don't take every signal. If you do, that's a losing game, because no single indicator or no single pattern is a winner by itself. You've got to put it in the wider context of things. So I would say the ABC pattern is best used in two scenarios. And obviously we're distilling it right down here, keeping it pretty simple, but it's when it's in the same direction of a clearly defined price trend. So what you're trying to do here is call the end of the correction within a price trend, and I'll show you a sort of simplistic diagram of this in a second. Or at a support and resistance level in sideways range. And a possible third option is where you think there's a top pattern taking place in an uptrend or a bottom in a downtrend, and you're using this as a trigger. I personally don't take option 3. That's why I've really said it's best used in the first of these two scenarios. Now this is key here. One of the best and most effective methods for using the ABC pattern is on a smaller time frame to trade in the direction of the higher time frame trend. So the point being here is that you see a market trending higher on the daily chart, for example. You drill down to a 4-hour or 1-hour time frame looking for these ABC patterns for confirmation that that daily trend is set to continue. So you've had a little bit of a retracement on a shorter term basis, but now it seems to be ending and it's continuing in that longer term trend. So this is kind of what I mean here. Very simplistically, we're in an uptrend, the price pulls back, but then we're looking for some evidence that pullback has ended. So obviously, you know, if you're confident this uptrend is going to continue, and obviously that's the whole basis of trend trading, right, is that the trend is going up, and you place a trade in the belief that it will continue going up. Of course, it may not continue going up, but that's the idea, is that oftentimes it will, or maybe if you control your risk enough, even if most of the time it doesn't, the times that it does, you'll make enough money to cover those times when it doesn't. So obviously, as I was saying before, you can just buy on the raw dip. You know, what's I haven't measured this out, but what would you call that? Maybe a 38% Fibonacci retracement? You could just buy on the 38, but what if it doesn't stop at the 38 this time? What if it stops at the 50 or the 61.8? Where's your stop going to be? Of course, there are ways, there are other areas of support and resistance. There are other ways to just put naked limit orders in there in the market. This is just an alternative. Instead of having that limit order waiting to try and pick the bottom of the dip for the uptrend to continue, you're waiting for this first push higher. Okay, a little bit of strength shown by the buyers. Sellers step in, but the buyers step in again and get aggressive. Sellers are obviously losing a bit of control here, and then the final confirmation is when buyers fully take over. Sellers may have been, if they were short at this point, they're going to be covering their shorts. They're going to be buying the market back. Buyers are going to be back in control. And the idea is that you go and at least maybe test the old high, or ideally go on for the trend to continue, and you maybe trail your stop or whatever you want to do to take your profits. But that's more of a subject for another webinar, because as I said, it's not a full trading system. It's not, we're not talking about how you actually would take your profits after this pattern occurs. There are different ways of doing that, but we're just talking about the pattern itself and how it can just simplify how you get into the market, like that entry trigger. So exactly the same thing with the downtrend. I'm not going to go over it in massive detail, but obviously the price is trending down. Get that bounce. Price can't trend forever, but the market you think is still weak for technical or fundamental reasons. You're looking for it to continue this downtrend. Get that first sign of weakness. A little bit of strength comes into the market, but it's not enough strength to get us up to the old high, and then we roll over and take out the low. So I hope that's all clear enough. I mean, it's pretty simple stuff, isn't it? This is about as simple as it gets, but oftentimes the simplest ways are the best. I'm sure you've heard it before, but they say KISS, keep it simple, stupid. That often is the best way, instead of trying to get overly technical on things. This is an example of it being a price range. So obviously I've only just shown the last couple of swings, but the idea is that price has been chopping around between a resistance and a support. That's the bottom of the range. Here's the top of the range, indicated by these two lines. The market's pulled back to the support. You think it's going to hold the support because you think the price range is, you've identified that the market is trading sideways. It's had a big leg down, but unlike in these previous examples where we've had the big leg down, you're expecting price to continue downwards. In this case, you've identified that it's not an uptrend or a downtrend. You've identified that it's a sideways range. You're looking for this ABC pattern to take you off back up to the top of the trend, the range again. And likewise, once you get up to the top of the range, you don't know if this top of the range will hold. You think it probably will, and law of probability says that ranges hold more often than they break. It only breaks once, but it holds several times before it breaks. So still, even that being the case, you don't just sell the naked price action near the top of the range. In fact, using this technique, you're waiting for that confirmation first. So that literally is all there is to it in terms of how you utilize the pattern. So I think at this point it makes sense to jump and shift gears to the trading platform. Let me get us into full screen. So there was Grenville, I'll jump into the good old DAX. So oh, got loads of lines all over this one. So obviously we're on a daily time frame for the time being. So what we're going to obviously try and do is find some examples of where this pattern might be starting to play out. So one obvious example will just be where we currently sit. Obviously that's of the most interest. We're below the moving averages. The market is acting fairly soft at the moment. To my mind, I don't really have any evidence of the fact, but I feel like we probably are still due another push higher. The market's holding up relatively well despite all this talk about Facebook, etc. But one example of the pattern taking place is obviously we've got a 1, 2, and then if we actually push to the top side, that would be taking out, if we take out these two highs, then we're basically taking out the correction. Now we've had a little extra pullback here, but that's the kind of glory of this pattern, right? Is that we needed a takeout to take out this high, but with this little latest pullback, we didn't actually get up to that old high. So again, if you'd got a bit, this pattern's going to be taking place, and you'd bought it lower down here, again, you'd be sitting in this loss for a while, still waiting for the trigger. But on this particular example, the pattern is yet to actually develop. So there are different ways to, say this breakout were to occur. The difficulty in this particular scenario is that we are going counter trend. So, 12,480, but we've got some pretty stiff resistance up at 12,600-ish. And then also once you start hitting into these lows over here. So again, that comes down to your own kind of risk management style in terms of whether you think there's enough room to the upside to kind of justify any kind of downside here. There are different ways of setting the stop loss. So the two main examples would be that once you've had the breakout through the high, that you just have a belief that the momentum's going to continue. So you have a very tight stop loss just below your entry point. Just set it a certain number of points where you think there's going to be enough wiggle room that if the market does pull back, this form of resistance is going to hold as support, right? So you're looking for the price to sort of do this, and then and then you have your stop loss in place, because who knows, it might do something like this, right? But you hope that's as far as it gets, and you leave a little bit of wiggle room because these things aren't perfect before it goes off and does something like that, right? The alternative is to be much safer on it and to have your, don't message me now, to have your stop loss way down below these lows. Now, obviously, this is always the conundrum is, if you have this stop loss this wide, you need to make the profits justify this risk. So instead of looking for a trade up towards these lows, you're probably going to have to look for a trade right up to the record highs to kind of justify taking on this kind of risk. And obviously there's everywhere in between. You could just go with the idea, well, it's probably not going to pull back any more than 50%. Of whatever this little push ends up being. Maybe I'll put the stop down beneath the 50%. All of these risk management techniques are the making and the breaking of these kinds of systems, but it's nice just to have a very simplistic entry trigger. So at least you're not, I think the market's it seems to be breaking out. Oh, what do I do now? Should I, you've got your entry method absolutely sorted out, so you can be very robotic about your entry method once you feel like you've identified this pattern, and then it's just a matter of kind of managing your risk on the scenario, and how best to manage your risk comes down to your own personality profile, and obviously just going back through your past trades and seeing, if I win, I can win X many trades and take this much risk, what seems to be working the best for me based on the trades I've already tried with this. That's why, it's not good to skip from one system to the other. Stick with this one system and just tailor it based on your, if you believe this system's right, and, there's no point in reinventing the wheel. I didn't come up with this ABC pattern. It's old as markets. So if you believe in the validity of the pattern, just tailor your system around it, and obviously improve your ability to identify the trend and all the rest of it. Let's have a look. Let's stick with the DAX. Anything going on a shorter time frame? Let's have a look. So, this obviously they don't occur at every turning point. So, if you look at this this recent peak that we've seen, what you obviously ideally want to see, say we've had this leg lower, right? And you know, you get to a point where there's been a pullback here, so we could have had our A and our B, and in this case we're all good because we didn't have why is that not working? We didn't have a C confirmation of taking out through the lows. Now we could obviously, but on this, on a kind of shorter term basis, say we were just going off this little rebound, we had, again, we didn't have a push through the lows here, but say if we're kind of switching it around, if I get rid of that, we've got a kind of an A and a B, and a C. It wasn't all plain sailing. But you can see that was the initial push. So say you think we're in a range, pushed up once, pulled back, had a little false breakout here, jittered around in loss-making territory for a while, and then eventually pushed up. But difficulty being, were you able to kind of take profits near the high? Or actually, did you have your stop loss trailing under, or even did you put it back to your break-even point? This would have been a fairly kind of tricky trade to really come away with decent money from. But I find often the case in a lot of trading strategies, especially a kind of system where you're going for the kind of big winners, a lot of the time, a lot of the trades end up, if you manage the risk properly, just end up being a bit of a scratch. So in this case, depending on how you manage the risk, probably a small loss, a small win, or just somewhere in the middle. But you keep trying the method because eventually you're going to have some kind of decent one. And so if we can go back to this situation, we could look at this situation where we've had a surge up here to a resistance level. Say we've been making gradually higher highs here. We have a big drop, but then we push higher again. Then we have a drop. And then we take off nicely to the top side this time. So on this occasion, maybe it was a bit more reasonable that you could actually expect to take some profits. And maybe our we had an eye on some sort of area of resistance like these lows through here. Maybe even just this spike low that we had. That's kind of where this trade petered out. So actually, we took out the high here and traded nicely up to a former area of support, turned into resistance. Maybe there was some Fibonacci that worked out. Let's have a look. Oh, actually, nicely ended up being the 61.8% retracement of this pullback as well, was roughly in the same area as these lows. So you had a little bit of a confluence to suggest maybe that's where the resistance was. And we eventually rolled over from that point. So again, this is the entry technique in place. But as you can see, it gives you a good, solid way to enter the market. But it of in itself is not necessarily telling you which direction to trade. The kind of broader analysis that was able to get you a profit from this benefit of hindsight trade is that actually, if we kind of scroll out to our sort of 4-hour chart or something, you can see that, again, it's, these things aren't perfect, but we're basically in a trading range, right? And this was a kind of longer term support down here. We reached that support of sorts. We didn't quite get down there, and if you'd been waiting for this level to get hit, it didn't quite happen, but you saw a big surge off the low, and then maybe you thought, based on this kind of trading range, now is the opportunity to start getting long. So it's that decision based on the assessment of the trading range, which is what really got you your money, instead of perhaps waiting for more short selling opportunities to look for this leg to continue going lower. It was that assessment that kind of made you your money, and then the ABC just gave you a very solid entry method to get into it. So if we drop down to the 1-hour chart, the other one thing I wanted to show you here is that it doesn't obviously call every turning point. So say we had this leg up and we thought, oh, based on this old support, maybe we are going to struggle a bit here, and oh, we got our first what was I trying to do here? Oh yeah, I thought this was quite a good example of how obviously you're going to get a few scratch and even losing trades from this. As we had a big leg up, okay, good surge of momentum, pull back from the resistance, all popped back above it. Okay, all looking good, right? Hopefully a big move to the top side to test up here, but no, unfortunately not. We kind of rolled over not far below it, and then if you had your stop down here, you get stopped out. So again, it's that you were calling for the market to push right up to the top of the range. You were calling for the breakout, but actually the breakout didn't occur on this occasion. You had your entry point maybe up here, taking out these highs, but it didn't follow through. Now, I would say that there are different ways of qualifying these patterns. And I mentioned at the start that ideally the pullback wants to be something more in the range of a sort of 50% pullback, because then it's more noticeable. This, is more of a kind of stutter, right? So really, can you define that as a pullback, or really are you looking at a move like this, where that's the peak, this is the pullback, and then actually when we get back through that high again up here, this is the ABC that you want to be paying attention to. So all takes a fair bit of practice to identify these things, but that's why you kind of want to have this kind of, having this kind of trading pattern can help you pre-plan how you want to be in the market. So you can tell yourself those kind of if-then statements. Like, I think that actually the market's on the border for recovery here. What I'm looking for is I'm going to place my entry up here, looking for a break to the top side, because I'm assuming this retracement's going to end. I'm not quite sure where it's going to end, but I'm going to kind of jump in to the top. So you pre-planned your trade, so you're not being reactive, you're being kind of predictive. Now, of course, maybe it won't actually end up testing those old highs or testing that resistance, but at least you've planned it, and if things do go awry, you can look back and see what was wrong with your plan and adjust it going forward. So yeah, we've got a question from Azelle, which is just saying, okay, how do we actually determine what are the valid patterns, and how do we combine it with other forms of analysis? So one thing I mentioned in the slides there is to combine the short term with the long term analysis. So a bit tricky on the DAX at the moment because we're in a bit of a chop. So let's see if from the benefit of hindsight, we can see something like this panning out. Something along the lines of, yeah, it has been a very choppy market, so obviously lots of volatility, but say this is our resistance, right? We're looking for opportunities up near resistance level. Then obviously this is our kind of 12-hour chart. If we jump down to our 1-hour chart, we're looking for signs of the ABC pattern at this resistance, right? So we've got the resistance level, which is our kind of first form of analysis. So there's various potential ABC patterns going on here. So for, near the top, so if you remember our slide, let's see, say we're in the range, right? We're looking for that first leg lower, little pop, and then a move down. We're looking for the same thing in the real market. Lost my trading platform. So we're looking for that move down. Okay, maybe it's starting to set up. We're not quite at the resistance yet. Move up. No, we actually make a new high. Okay, scratch that. Okay, move down. Pop up, and then there's your potential entry point, right? So you So you've identified the resistance area. Again, depends how you've identified it. It's somewhere in that region, right? You're looking for selling opportunities because you think the range is going to continue, and then here's the trading pattern to keep you on side. Now, in the case of a range, obviously the moving averages don't really particularly help you. But if we can find a trending market, so I think sterling maybe, no, it's not particularly on the shorter term. It has. So something like this, right? Here's the big surge to the top side in sterling, right? We've got the transition agreement, so everyone's all getting pretty pumped up for buying a pound. We have the pullback. So that would be so this, now we're switching gears to the kind of trending idea, right? So here's our we've got our uptrend, we've got our pullback, and then we're looking for that first surge off the low and then giving us that. So surge off the low, just pull back, and then we're looking for maybe the market to continue from here. We do get it, but no joy this time, right? We've had a big surge higher, but if you are combining some kind of other analysis, maybe you've decided that actually you don't take pullbacks that are this shallow. So what was that? Probably more like a 38. So actually you can see here the market's pulled back only 38%. The ABC didn't want to work that time. The market wasn't ready to break to the top side. But we got this opportunity down here, actually near the 61.8% fib level, or near the 50 perhaps. Let's see, add in the 50. I don't think it's going to particularly clarify things so much. No, it isn't. But you've got those levels in mind, so you're aware of how much the market's dipping. So now let's look at this next little surge off. We've had this another correction down here. We're still confident pound's going to go up because look, we're in a transition now. Brexit's going to be all good, right? And there's our push to the top side. We've actually taken out, we had a little bit of, this is even better because we've had a little stutter before the breakout. So instead of having to have your stop down here this time, you've actually got some legitimate reasons to have your stops, nearer these closer pullbacks instead of all the way down here. So you can very tight stop loss, target the old highs, obviously benefit of hindsight. This trade's panned out quite well. Take your profit at the old resistance. And then obviously we're in a stage of another little pullback here. Will we get a little pop with a drop to then encourage us to take out these highs? It's just a little bit of structure to see the market go through to believe that maybe we're in for another breakout. So guys, I'm going to leave it about there. I think we've hit the half an hour mark. I hope that was of some use. I hope that was interesting, and it's something that you can add to your arsenal. If you haven't done so already, obviously get going with the demo or the live trading account with LCG. And for the latest updates on the next webinars and all the news that's driving the markets, please follow me on Twitter or contact customer services at LCG. Cheers, guys. Jasper signing out.